Before we dive in, it is crucial to understand that this presentation is for informational and educational purposes only. I am not a licensed financial advisor, mortgage broker, or real estate agent. The information provided in this video is not intended as financial, legal, or tax advice. The mortgage process is highly individual, and you should always consult with qualified professionals before making any financial decisions. Your financial situation is unique, and the steps you take should be tailored to your specific circumstances. Let's talk about Sarah. Sarah had everything lined up. A great job she'd held for 5 years, a solid 20% down payment saved up in her bank account, and a credit score in the mid-700s that she was proud of. She found the perfect house, the one with the big backyard for a future dog, and the kitchen that got all the morning light. She put in an offer, it was accepted, and for a week she was living on a cloud, picking out paint colors in her mind. Then the call came. The loan officer on the other end of the line was apologetic but firm. The bank had to deny her mortgage application. Her dream, the one she had worked years to build, was shattered by a single phone call. The worst part? The reason for the denial was a completely fixable issue related to a student loan payment from 2 years prior that she didn't even know was a problem. It was a ghost in her financial machine, and it cost her the house. This story, or a version of it, happens to thousands of Americans every single day. Over a third of first-time homebuyers face a rejection at some point in their journey. They hit a brick wall they never saw coming. Why? Because the mortgage application process in the United States isn't just a process. It's a gauntlet. It's a labyrinth of confusing jargon, hidden rules, and last-minute demands designed to protect the bank, not to help you. It's designed to make you feel small, to make you feel like you're asking for a favor, when in reality you are the customer. You are the prize. This 10-part series is your map through that labyrinth. This is your secret playbook. We are going to demystify every single step, from the first thought of buying a home to the moment you're holding the keys in your hand. We will tear down the wall of confusion and replace it with a staircase of confidence. By the end of this journey, you will not be hoping for an approval. You will be walking into that lender's office knowing exactly what they need, why they need it, and how to give it to them. You will be in control. And it all starts right here, with the single most misunderstood and critically important step in the entire journey: the pre-approval. Most people think a pre-approval is just a casual first step, a quick check to see how much house they can afford. That is dangerously wrong. A pre-approval is not a suggestion. It is a full-blown financial autopsy. It is the bank putting your entire financial life under a microscope before they're willing to bet millions of dollars on you over the next 30 years. Getting this step right isn't just important, it's everything. A strong pre-approval is your golden ticket. It's what makes a real estate agent take you seriously. It's what makes a seller choose your offer over someone else's. A weak or non-existent pre-approval gets your email sent straight to the trash folder. So what are they actually looking at? When you submit that application, the underwriter, the ultimate decision maker at the bank, is going to dissect 3 core pillars of your financial life. Let's call them the 3 C's: capital, capacity, and credit. First, capital. This is the cash. Where's your down payment coming from? Is it in your checking account? A savings account? A 401k loan? Did your parents gift it to you? The bank needs to know, and more importantly, they need to see a paper trail. They want to see that this money has been seasoned, meaning it's been sitting in your account for at least a couple of months. A sudden massive deposit of $10,000 a week before you apply for a mortgage is a giant red flag. To them, it looks like an undocumented loan from a friend, which is just another debt you have to pay back. They need to see where every single dollar came from. This also includes your closing costs and your reserves, the extra cash you'll have left over after the purchase. They want to see that you won't be flat broke on day one. Second, capacity. This is your ability to repay the loan. It's all about your income. How much do you make? And more importantly, how stable is it? If you're a W-2 employee who's been at the same job for 3 years with a steady salary, that's a green light. It's predictable. It's safe. But what if you're a freelancer? A gig worker? A small business owner? Now it gets complicated. The bank doesn't care about the one amazing month you had last year. They want to see a 2-year average. They will scrutinize your tax returns, looking for consistency. They're trying to answer one question: is this person a reliable bet for the next 360 monthly payments? Any gaps in employment, any recent job changes, especially if it involves a career switch or a move to a commission-based role, will get extreme scrutiny. You have to be prepared to document and explain everything. And third, the big one, credit. Your credit score is the first thing people think of, and yes, it's a vital snapshot. But the underwriter is looking so much deeper than that 3-digit number. They are reading the story of your credit report. They're looking at your payment history. Any late payments in the last few years? They're looking at your credit utilization. Are your credit cards maxed out? They're looking at the mix of credit you have: a car loan, student loans, a credit card. But the killer metric here is your debt-to-income ratio, or DTI. This is the number that sinks more applications than anything else. It's simple math. They take all your monthly debt payments, your car loan, your student loans, your minimum credit card payments, and add your new proposed mortgage payment. Then they divide that total by your gross monthly income. That percentage is your DTI. Most lenders have a hard and fast limit, often around 43 to 45%. If your new mortgage pushes you over that line, you are denied. Period. It doesn't matter if you have a perfect credit score or $1 million in the bank. The DTI rule is king. This is where people get blindsided. They get approved for a new car loan 6 months before buying a house, adding $600 to their monthly debt, and in doing so, they unknowingly disqualify themselves from the very mortgage they were saving for. Capital, capacity, credit. These are the 3 legs of the stool. If one is weak, the whole thing collapses. The pre-approval process is designed to test all 3 rigorously. So you need to stop thinking of it as a hurdle to clear and start thinking of it as a tool to be used. The pre-approval is a free professional audit of your home buying readiness. It tells you your real budget, not the fantasy number from an online calculator. It uncovers problems like that ghost student loan payment Sarah had, while you still have time to fix them. It transforms you from a window shopper into a serious contender. Getting pre-approved is your first battle in the war of homeownership. Winning it sets the stage for everything that follows. It gives you the confidence, the credibility, and the clarity to move forward. But knowing what they look for is only half the battle. Now you need the strategy. You need to know exactly how to prepare your documents, what to say to the loan officer, and the critical mistakes that you must avoid at all costs. You need to assemble your financial arsenal before you ever step foot on the battlefield. This is the armory. This is where you forge the weapons and polish the armor that will see you through the entire campaign. So many people get this wrong. They walk into a lender's office with a vague idea of their finances, hoping for the best. That's like showing up to a gunfight with a water pistol. The lender, and more importantly, the underwriter, think of them as the final boss. They don't operate on hope. They operate on proof. Cold, hard, documented proof. Your mission, should you choose to accept it, is to build an undeniable case for your financial stability. You will leave no room for questions, no space for doubt. We can break down your entire arsenal into what I call the Trinity of Proof. 3 core pillars that your entire application will be built upon. They are proof of income, proof of assets, and proof of creditworthiness. Get these 3 right, and you're already ahead of 90% of other applicants. Let's start with the big one, proof of income. This is the engine of your application. It tells the lender you have the horsepower to carry a mortgage payment, month after month, year after year. Now, how you prove this depends entirely on your employment status. If you are a W-2 employee, meaning you get a regular paycheck from a company, you are the infantry of the mortgage world. You are predictable, stable, and easy for lenders to understand. Your primary weapons are your most recent W-2 forms, typically from the last 2 years. These are the official government record of your earnings. Think of them as your certified service record. Next, you'll need your most recent pay stubs, usually covering the last 30 days. These show your current, up-to-the-minute earnings and prove you're still actively employed and earning what your W-2s claim. Finally, you'll need your last 2 years of federal tax returns, every single page. Don't just send the summary page. They want the whole novel, including all schedules. For the W-2 soldier, this is a straightforward mission. Gather these documents and your proof of income is rock solid. But what if you're self-employed? A freelancer, a business owner, a 1099 contractor? If the W-2 employee is the infantry, you are the special forces operative. You are highly skilled, adaptable, and your income might be massive, but it's not as predictable. A lender looks at you with a mix of awe and suspicion. They need more convincing. Your mission is tougher. You'll still need your last 2 years of personal tax returns, all pages. But you'll also need your business tax returns for the same period. On top of that, you'll likely need to provide a year-to-date profit and loss statement, or a P&L for your business. This document shows your revenue, your expenses, and your net profit. Why do they need all this? because they need to see a stable, or preferably, an increasing pattern of income over at least a 24-month period. One great year followed by a terrible year won't cut it. They are averaging your income over 2 years to create a conservative, reliable number. For the self-employed, documentation is not just a task. It is your shield and your sword. Over-prepare. Have everything ready. Now let's move to the second pillar of the Trinity. Proof of assets. This isn't about how much you make. It's about what you have. This is your war chest. It proves you have the funds for the down payment, for the closing costs, and that you have reserves left over for emergencies. Lenders call this liquid assets. Your primary evidence here will be your bank statements, checking accounts, savings accounts, money market accounts. Typically, you'll need the last 2 to 3 months of statements for every single account you have. And they want every single page. Yes, even the blank one at the end that says, "This page intentionally left blank." Don't ask why, just provide it. But here is where the most common and devastating landmine is hidden. Lenders are financial detectives. They will scrutinize every line of your bank statements. They are looking for something specific. Large, undocumented deposits. Let's say your aunt gives you $10,000 in cash for your down payment. You gratefully deposit it. To you it's a gift. To an underwriter it's a giant red flag. They see it as a mystery deposit. Where did it come from? Is it a loan you're not disclosing? Is it mattress money that can't be sourced? Any deposit that isn't from your regular payroll will be questioned. This single mistake can derail your entire application. So how do you handle it? If you are receiving a gift from a family member, it must be documented with a gift letter. This is a simple letter, signed by the person giving you the money, stating that the funds are a true gift and not a loan that needs to be repaid. You'll also need a paper trail showing the money leaving their account and entering yours. No cash. Ever. Wire transfers or cashier's checks are your best friends here. You need to be able to source every single dollar in your account for the last 60 to 90 days. So, a critical rule of thumb. From this moment forward until you have the keys to your house, do not move large sums of money around. Don't deposit cash. Keep your financial life as clean and simple as possible. Your bank statements need to tell a boring, predictable story. The third and final pillar is proof of creditworthiness. This is your reputation on the battlefield. It's a history of every financial promise you've ever made and whether you kept it. Your primary document here is your credit report. The lender will pull this themselves, but you must not see it for the first time when they do. You need to pull your own credit report from all 3 bureaus, Equifax, Experian, and TransUnion, months in advance. You can do this for free. Scour it for errors. A medical bill that's not yours? A late payment you know you made on time? Dispute these immediately. Cleaning up your credit report can take months, which is why this is part of the preparation phase, not the application phase. Beyond the credit report, you'll need proof of identity, a clear copy of your driver's license and your social security card. Simple, but don't forget it. Now, with the trinity of proof assembled, your income, your assets, and your credit, you have one final secret weapon in your arsenal. This is the tool that separates the amateurs from the pros. It's called the letter of explanation, or LOX. An underwriter's job is to question everything. A gap in your employment history? They'll question it. A weird withdrawal from your bank account? They'll question it. A late payment on your credit report from 3 years ago? They'll question it. A letter of explanation is a preemptive strike. It's a simple signed letter where you explain any potential red flags in your file before they even ask. Had a period of unemployment because you went back to school? Write a LOX explaining the dates and the reason. Have a credit blip because of a hospital stay? Write a LOX. That large gift deposit from your aunt? Even with the gift letter, you write a LOX explaining the context. You are controlling the narrative. You are anticipating the underwriter's questions and providing clear, concise answers up front. This shows that you are organized, transparent, and on top of your finances. It builds an incredible amount of trust and can speed up your approval process dramatically. So there you have it. Your financial arsenal is complete. You have your W-2s or your tax returns. You have clean sourced bank statements. You know your credit report is accurate. And you have your secret weapon, the letter of explanation, ready to deploy. You are no longer just a hopeful buyer. You are a prepared applicant, armed with undeniable proof. You are ready for the next step. You are ready to make first contact with the lender. But walking into that meeting isn't just about handing over a pile of papers. It's an intelligence gathering mission. There are specific questions you must ask them, and specific red flags you must watch out for. That will determine whether you get a great loan or a financial nightmare. And that is exactly where we're going next. You are about to conduct one of the most important job interviews of your life. But you're not the one being interviewed. You are the hiring manager. You are the CEO. The company you're running is called My Future Financial Life, Incorporated, and you're about to hire a partner for the next 30 years. That partner is your mortgage lender. Too many people walk into this conversation timid, hat in hand, hoping the lender will approve them. That's the wrong mindset. You are the prize. You are bringing them hundreds of thousands of dollars of business. They are competing for you. Your job is to grill them, to vet them, and to find the absolute best candidate for the job. So let's arm you with the questions that separate the pros from the predators. Pull out a notebook because you're going to want to write these down. First, we tackle the hard numbers, the non-negotiables. Question number 1, and it's a two-parter. What is the interest rate? And what is the annual percentage rate, or APR, for this loan? If they only give you the interest rate, that's your first pink flag. The interest rate is just the sticker price. It's the shiny advertised number. The APR is the real price. It includes the interest rate plus most of the lender's fees and costs, all rolled into a single percentage. Think of it like this. The interest rate is the price of the car on the billboard. The APR is the out-the-door price after they've added in the mysterious dealer prep fees and document processing charges. Two lenders could offer you the exact same interest rate, say 6.5%, but one might have an APR of 6.65% and the other an APR of 6.9%. That second lender is hitting you with higher fees, and over 30 years, that tiny difference can cost you thousands upon thousands of dollars. Always compare by APR. Next, you look them in the eye and ask question 2. Can you provide me with a line item breakdown of all estimated closing costs? This is where they can hide the junk. You're listening for terms like origination fees, processing fees, underwriting fees, discount points, appraisal fees, credit report fees, and title insurance. Don't let the jargon intimidate you. An origination fee is basically the lender's commission for doing the loan. Discount points are something you can choose to pay up front to buy a lower interest rate. We'll do a deep dive on whether that's a good idea later in the series. For now, you just want to see all the cards on the table. A great lender will walk you through each fee and explain what it's for. A shady one will get defensive or vague, saying things like, "Oh, that's just standard stuff." There is no standard stuff. It's your money. Demand specifics. This leads directly to the single most important question you can ask at this stage. Question 3. Will you provide me with an official loan estimate form? This is the holy grail. The loan estimate is a standardized, government-mandated, 3-page document. It was created specifically to solve the problem of lenders hiding fees. It forces every lender to present their offer in the exact same format, so you can easily compare them side by side. It lists the interest rate, the APR, the estimated monthly payment, and a detailed breakdown of all those closing costs we just talked about. Asking for a loan estimate is your power move. It shows you're a serious, educated buyer. It tells the lender they can't play games with you. Any lender who hesitates, makes excuses, or tries to give you a worksheet instead of the official form is a colossal red flag. Run. Do not walk. Run. Your goal is to get official loan estimates from at least 3 different lenders. This is your leverage. This is how you win. Before we move off the numbers, there's one more crucial money question. Question 4. Does this loan have a prepayment penalty? A prepayment penalty is a fee a lender can charge you if you pay off your mortgage too early. It's an outrageous anti-consumer trap. It punishes you for being financially responsible, for getting a bonus at work and wanting to pay down your principal, or for wanting to refinance to a better rate in a few years. While they've become less common for standard loans, they still exist, especially in the subprime space. The answer to this question should be a simple, unequivocal no if there's any hesitation, or if the answer is yes, you thank them for their time and you walk away. End of interview. Okay, you've grilled them on the numbers. Now it's time for the second part of the interview, the personality fit. This is about the process, the communication, and how they handle problems. Because when you're 3 weeks from closing and something goes wrong, and something always goes wrong, the person you're working with matters more than anything. So you ask question 5. Who will be my single point of contact through this entire process? And what is your typical response time for emails and phone calls? You are trying to find out if you'll be working directly with the loan officer you're talking to now, or if you're about to be handed off to a faceless processing department in another state. There is nothing more stressful than having an urgent question and getting an automated, "We'll respond in 24 to 48 business hours" reply. A great loan officer is your quarterback. They coordinate with the underwriter, the appraiser, the title company, and your real estate agent. You want a quarterback you can call directly. Ask them what happens if they go on vacation. A pro will have a dedicated, fully briefed partner ready to step in. An amateur won't have an answer. Their communication style right now, in this initial call, is the absolute best it will ever be. If it's bad now, it will be a catastrophe later. Next, question 6. What is your average time to close a loan, from application to funding? In a competitive real estate market, speed is a weapon. A seller choosing between two similar offers will often pick the one that can close faster. If your lender takes 45 days and another buyer's lender can close in 21, you lose. A confident lender will know their numbers. They'll say something like, "Our average is 25 days, but for a well-qualified borrower like you with all your documents in order, we can often close in as little as 18. A less confident lender will give you a vague, wide range. This question isn't just about speed, it's about competence. A fast closing time indicates a streamlined, efficient, well-run operation. Finally, you ask the stress test question, the one that reveals how they perform under pressure. Question 7. What is your process if the home appraisal comes in lower than the purchase price? This happens all the time and it can blow up a deal. A low appraisal means the bank won't lend you the full amount you need. A bad loan officer will just deliver the bad news and say, "Sorry, you'll have to come up with more cash or the deal's dead." They put all the pressure on you. A great loan officer, a true partner, will immediately shift into problem-solving mode. They'll say, "Okay, first, we'll analyze the appraiser's report for any errors. We can file an appeal. I can provide the appraiser with better comparable sales to support the price. We can also discuss options like renegotiating with the seller or restructuring the loan." Their answer reveals whether they see themselves as a paper pusher or a strategic advisor. You are only hiring a strategic advisor. By now, you have a complete picture. You have the hard numbers from their loan estimate. You understand their communication style and their problem-solving skills. You've screened for red flags like prepayment penalties and vague answers. You have turned a confusing, intimidating process into a systematic evaluation. You've taken control. You'll do this with at least 3 lenders, a big national bank, a local credit union, and an independent mortgage broker, to get a full spectrum of options. You'll thank each of them for their time and tell them you'll be in touch. No pressure. No rush. You're the CEO, remember? You're weighing your options. You now have the most powerful tools in home buying. Multiple competing offers in a standardized format. But having the tools and knowing how to use them are two different things. Hidden within the lines of those loan estimates are traps and opportunities. One might have a lower rate but sky-high fees. Another might look more expensive up front but save you a fortune in the long run. Your intelligence gathering is complete. Your next mission is to become a codebreaker, to analyze these documents like a forensic accountant, and to make the single choice that will shape the next 360 months of your life. Within 3 business days of submitting your application, a critical document will land in your inbox. It's called the loan estimate, or LE for short. And this isn't just another form. This is the enemy's battle plan, laid out in plain sight. It's a standardized 3-page document created by the government precisely so that you can compare offers from different lenders, apples to apples. For decades, lenders could hide fees in confusing, custom-made documents. But not anymore. The loan estimate is your secret weapon. Your job is to become fluent in its language. Let's start with page 1. Think of this as the executive summary, the Rosetta Stone that translates the entire deal into its most critical components. Right at the top, you'll see the loan term, purpose, product, and loan type. Is it a 30-year or 15-year loan? Are you purchasing or refinancing? Is it a fixed rate or an adjustable rate mortgage? These are the fundamentals. If any of this is wrong, stop right there. It means there was a major miscommunication with your loan officer. Next, you'll see the loan amount. Simple enough. But right below that is the single most seductive number on the page. The interest rate. This is the number everyone obsesses over. And right next to it, you'll see a crucial question. Can this amount increase after closing? For a fixed-rate mortgage, the answer should be a glorious, resounding no. You'll also see if your rate is locked and for how long. An unlocked rate is just a guess. A locked rate is a promise. Now your eyes will drift down to the projected payments section. This is where reality hits. You'll see your principal and interest payment. This is the core mortgage payment that goes toward paying down your loan balance and covering the interest. But that's not what you'll actually write a check for each month. The next line is estimated escrow. This is where the lender collects money for your property taxes and homeowner's insurance on your behalf. They put it in a special account and pay the bills for you when they're due. So your principal and interest plus that escrow amount equals your estimated total monthly payment. This is the number you need to burn into your brain. This is the number that has to fit into your monthly budget. Finally, at the bottom of page 1, you'll find the estimated closing costs and estimated cash to close. The first is the grand total of all the fees to get the loan done. The second is that total plus your down payment minus any deposits you've already made. This is the amount of money you need to bring to the closing table. Remember, the key word here is estimated. It can and likely will change slightly, but it shouldn't change dramatically. Now flip to page 2. If page 1 was the executive summary, page 2 is the forensic audit. This is where you put on your green visor and analyze every single line item. This is where lenders use to hide the junk fees. It's broken down into sections. Section A is origination charges. This is the lender's profit. It's what they charge you for the service of creating the loan. You might see a percentage of the loan amount, often called points, which you pay to get a lower interest rate. Or you might see a flat application fee or underwriting fee. This section is pure profit for the lender, and it's one of the most important numbers to compare between different loan estimates. A lender might offer a slightly lower interest rate, but if their origination charges in Section A are thousands of dollars higher, are you really getting a better deal? Probably not. Section B is services you cannot shop for. These are third-party fees for services the lender requires, and they choose the provider. Think of the appraisal fee, the credit report fee, a flood determination fee. You have no say in who performs these services, so you can't shop around for a better price. These fees should be nearly identical from lender to lender. If one lender's appraisal fee is double another's, that's a massive red flag. Now for the good part, Section C, services you can shop for. This is your opportunity to take control and save real money. These are required services, but the lender has to let you choose your own provider if you want. The big one here is title insurance. The lender will provide a list of companies, but you are not obligated to use them. You can and should call a few local title companies and compare their fees for the lender's title policy and settlement services. Shaving off a few $100s here is a very real possibility. All these costs from A, B, and C are added up in Section D, total loan costs. The rest of the page details other costs, like taxes, prepaid homeowner's insurance, and prepaid interest. It all gets added together to give you that final total closing costs number, which should match the number on page 1. Now for page 3. This is the mission debriefing. It gives you context and helps you make a final comparison. At the top, you'll find the comparisons table. This is pure gold. It shows you how much you will have paid in total over the first 5 years of the loan, and how much of that was actually principal. This is a fantastic way to compare two loans that look similar on the surface. A loan with slightly higher fees but a lower rate might actually save you money over 5 years, and this table proves it. Below that, you'll find the APR or annual percentage rate. This is the second most misunderstood number in the mortgage world. The interest rate is just the cost of borrowing the money. The APR is the cost of borrowing the money plus most of the closing costs, expressed as an interest rate. It's the truer cost of the loan. If lender A offers a 6.5% interest rate and lender B offers a 6.6% rate, you might automatically jump for lender A. But if lender A's APR is 6.8% and lender B's is 6.7%, it means lender B has lower fees and is actually the cheaper loan over the long term. The APR is your ultimate comparison tool. The rest of page 3 gives you some other important information, like whether the lender intends to service your loan themselves or sell it to another company. Your mission now is to get loan estimates from at least 3 different lenders. Lay them out on your kitchen table side by side. Don't just look at the interest rate. Look at the APR. Compare Section A, the lender's fees, on page 2. Which lender is charging you the most for their services? Look at the cash to close on page 1. Which deal requires the least amount of cash out of your pocket right now? Look at the 5-year cost comparison on page 3. Which loan saves you more in the long run? This is not a simple choice. It's a balance of upfront costs versus long-term savings. One lender might offer a no-cost loan, but they roll all the fees into a much higher interest rate. Another might have a rock-bottom rate, but requires you to pay thousands of dollars in points up front. There is no single right answer. There is only the right answer for you. By breaking this code, you've transformed from a hopeful homebuyer into an educated consumer. You've seen behind the curtain and understood the true cost of the product you're about to buy. You've analyzed the offers, weighed the variables, and you're ready to make your choice. You pick up the phone. You tell one loan officer, "Let's do this." With that single sentence, you've chosen your financial partner for this journey. But choosing your ally is one thing. Now you have to prove you're worthy. You are about to enter the most intense, invasive, and stressful part of the entire process. A deep dive forensic audit, not of the lender but of you. You are about to go into underwriting. The underwriter. You will likely never speak to them. You will never see their face. They exist as a name at the bottom of an email, a mysterious entity in a department you can't call, holding the entire weight of your homeownership dream in their hands. They are the judge, jury, and financial executioner. Their one and only job is to answer a single brutal question. If we give this person hundreds of thousands of dollars, what is the statistical probability that we will get it back on time every time for the next 30 years? To answer that question, they don't just look at your application. They dissect it. They become financial archaeologists, digging through the last 2 to 7 years of your life, looking for clues, patterns, and red flags. They operate on a principle of trust but verify, except they throw out the trust part. It's just verify, and then verify the verification. This entire process is built around a framework, a set of pillars that every single loan must stand on. They are often called the 4 C's of underwriting: capacity, capital, credit, and collateral. Your entire financial life is about to be filtered through these 4 lenses. Let's start with the first and arguably the most important: capacity. This is the simplest C to understand but the hardest to fake. It asks, do you have the capacity to repay this loan? Can you actually afford this house? It's not about what you think you can afford. It's not about how well you budget or how little you eat out. It's about cold, hard mathematical proof. The underwriter's main tool here is the DTI, or debt-to-income ratio. Imagine your gross monthly income. That's your income before taxes, before health insurance, before anything is taken out. Imagine that's a big, delicious pizza. Now, the underwriter takes a slice of that pizza for your new proposed mortgage payment. That includes the principal, the interest, the property taxes, and the homeowner's insurance. Then they start taking more slices for all your other existing debts that show up on your credit report. Your car payment? That's a slice. Your student loans? That's a big slice. Your minimum credit card payments? Slice, slice, slice. What they want to see is how much pizza is left for everything else. For groceries, for gas, for utilities, for life. Generally, lenders want to see that all those debt slices combined don't take up more than 43% to 45% of your total pizza. Some programs are more lenient, some are stricter. But if your debts, including the new house, are eating up more than half of your pre-tax income, a siren goes off in the underwriter's head. It's a signal of risk. To prove your income, they want everything. Pay stubs from the last 30 days? Check. W-2s from the last 2 years? Check. And they don't just look at the numbers. They look for consistency. Are you getting paid regularly? Is there overtime? Is that overtime consistent? Or was it a one-time fluke? If it was a one-time thing, they'll ignore it. They only care about stable, reliable, and likely to continue income. If you're self-employed, this gets even more intense. They'll want 2 years of full tax returns, personal and business, and they'll scrutinize every single line item, averaging your income, looking for trends. An upward trend is good. A downward trend is a massive red flag. They are building a story of your financial stability. Next up is capital. This is about your skin in the game. Do you have enough cash for the down payment, the closing costs, and some leftover for emergencies? These leftover funds are called reserves. The underwriter wants to see that you're not draining every last cent you have to get into this house. They want to know that if your water heater explodes the day after you move in, you have the cash to fix it without missing a mortgage payment. A typical requirement is to have a few months' worth of mortgage payments sitting in your account after you close. But here's where people get tripped up. It's not enough to just have the money. The underwriter needs to know the money's life story. They will demand the last 2 to 3 months of bank statements for every account you have. And they will analyze them like a detective at a crime scene. They are looking for sourcing and seasoning. Seasoning means the money has been sitting in your account for a while, usually at least 60 days. Sourcing means they know where it came from. Did you get a big bonus from work? Great, they'll want to see the pay stub that shows it. Did you sell some stock? Fantastic, they'll want the brokerage statement. Did your grandma give you $20,000 as a gift? Wonderful. But you can't just deposit it. That's a huge red flag. A large, undocumented cash deposit looks like a secret, undisclosed loan to an underwriter. It looks like you borrowed the down payment, which adds to your debt and your risk. To use that money from grandma, you'll need a formal gift letter, signed by her, stating that the money is a true gift and not a loan that needs to be repaid. And they'll want to see the paper trail, the money leaving her account and entering yours. Mattress money, that cash you've been saving in a safe at home, is the underwriter's worst nightmare. If you deposit $5,000 in cash a month before closing, you might as well have set off a flare. You will not be able to use that money. All capital must have a clear, documented, and legitimate origin. The third C is credit. This is your financial report card. It's the story of your past promises. The underwriter pulls a detailed tri-merge credit report, combining data from all three major bureaus, Equifax, Experian, and TransUnion. They look at your FICO score, yes, but that's just the headline. They read the whole article. They look at your payment history. Do you pay your bills on time every time? A single 30-day late payment in the last year can be a major issue. They look at your credit utilization. Are all your credit cards maxed out? That suggests you might be living beyond your means. They look at the length of your credit history and the mix of credit you have. They are looking for a long history of responsibly managing different types of debt. And they look at recent inquiries. Have you been applying for a bunch of new credit cards or a new car loan right in the middle of the mortgage process? This is a cardinal sin. It changes your debt-to-income ratio and tells the underwriter you might be about to take on more debt than they've accounted for. Every single detail on that report tells a piece of your story, and the underwriter is trained to read between the lines. Finally, we have the fourth C, collateral. This isn't about you at all. It's about the house. The underwriter is not just approving you. They're approving the property. The house is the collateral for the loan. If the worst happens and you stop paying, the bank needs to know they can sell the house and get their money back. The key document here is the appraisal. A licensed third-party appraiser will go out to the property, inspect it, measure it, and compare it to recently sold, similar homes in the area to determine its fair market value. The underwriter reviews this appraisal with a fine-tooth comb. Does the value support the loan amount? Is the property in good condition? Are there any safety issues? If you agreed to buy the house for $400,000, but the appraiser says it's only worth $380,000, you have a problem. The bank will only lend based on the lower value. The underwriter's job is to protect the bank from overpaying for an asset. So the underwriter takes these four pillars: your capacity to pay, the capital you've invested, your credit history of keeping promises, and the value of the collateral, and they put it all together. They are looking for strengths to offset any weaknesses. Maybe your credit score is just okay, but you have a huge down payment and tons of reserves. That might work. Maybe your DTI is a little high, but you have a perfect credit score and a stable job you've been at for 10 years. That helps. It's a balancing act. And after days of silence, after you've sent them every financial document you've ever touched, you'll finally get a notification. But it's almost never a simple, "You're approved." Instead, you get something far more terrifying and hopeful at the same time. A conditional approval. It's the underwriter saying, "Okay, I've reviewed your life. I think we can make this work. If you do these 10 other things first." This list of conditions is the final boss battle of your mortgage application. It's the last gauntlet you have to run, and the underwriter is the gatekeeper. They've gone through every single page of your life you've submitted, and now they have questions. Lots of them. This is where deals live or die. It's where your patience will be tested to its absolute limit. And your mission, should you choose to accept it, is to satisfy every single one of these conditions as quickly and as thoroughly as humanly possible. Because until you do, that conditional approval is just a piece of paper with a very expensive maybe written on it. The conditions will arrive in a cold, sterile-looking list from your loan officer. There's no fanfare. It just appears in your inbox. And they typically fall into a few categories. The first is what I call the mop-up. This is the easy stuff. The underwriter will almost always ask for the most recent version of documents you've already provided. They'll want your most recent pay stub because the one you sent 3 weeks ago is now, 3 weeks old. They'll want your most recent bank statement to make sure you haven't suddenly drained your savings account to buy a speedboat. This is standard procedure. It's annoying, it feels redundant, but it's simple. You get the document, you upload it. Done. Think of this as the warm-up. But then you get to the second category, the Please Explain section. This is where the underwriter's magnifying glass has found something they don't understand, and their job is to assume the worst until you prove otherwise. The most common culprit? A large, mysterious deposit. Let's say 2 months ago, $10,000 magically appeared in your checking account. You know exactly what it is. It was a generous gift from your parents to help with the down payment. You thank them profusely, you move the money, you thought nothing of it. The underwriter, however, doesn't see a gift. They see a secret, undocumented loan. They see a liability that you didn't disclose on your application, which could wreck your debt-to-income ratio. So on your list of conditions, you will see a line item that says, please source and season the large deposit of $10,000 in checking account ending in 1234. Sourcing and seasoning is lender speak for prove to me where this money came from and that it's legitimately yours to use. This means you now have to go back to your parents and execute a very specific set of documents. First, you need a gift letter. This is a formal letter, signed by your parents, stating that the $10,000 is a true gift, not a loan, and that there is no expectation of repayment. Your lender will give you a template for this. But that's not enough. You also need to prove the money actually came from them. This means you'll need a copy of your parents' bank statement showing the $10,000 leaving their account, and a copy of your bank statement showing it arriving in yours. Yes, you have to ask your parents for their bank statement. It's awkward, but it's non-negotiable. The underwriter needs to see the complete paper trail, a clear, unbroken line from their account to your account. The next thing they'll flag is any weird activity. Maybe you paid your car insurance for the whole year at once, a withdrawal of $1,800. The underwriter sees a large, unexplained payment. Again, they assume the worst, maybe you were paying off a loan shark. So you'll have to write something called a letter of explanation, or LOX. This is you, in your own words, explaining what a transaction was for. Doesn't have to be a novel. To whom it may concern. The withdrawal of $1,800 on May 15th was a one-time payment for my annual auto insurance premium. Please see the attached receipt from my insurance company. Sincerely, the person who just wants a house. You will become an expert at writing these letters. And then there's the credit report. Remember how your loan officer told you not to even breathe on your credit report? The underwriter is now looking at the most recent version, and they see a new inquiry. An inquiry from a big box electronics store from 2 weeks ago. You remember it. You were buying a new washer and dryer for the house you don't even own yet, and the cashier offered you 15% off if you just applied for their store card. You thought, what's the harm? The harm is a panic attack for your loan officer, and another condition from the underwriter. You will now have to write another letter of explanation, stating that yes, there was a credit inquiry, but no, a new account was not opened, and no new debt was taken on. You have to prove that this little moment of trying to save $100 didn't fundamentally change your financial picture. This back and forth can feel endless. You upload a document and a day later another question comes back. The bank statement you provided is missing page 3 of 4. The signature on the gift letter doesn't match the signature on the driver's license. Every detail is scrutinized. It is maddening. You have to be organized, responsive, and above all patient. But the most nerve-wracking conditions are the ones that are completely out of your hands. These are the third-party validations. The biggest, scariest one of all is the appraisal. The lender hires an independent, third-party appraiser to determine the fair market value of the home you want to buy. The lender will only lend you money based on the appraised value or the purchase price, whichever is lower. So if you agreed to buy the house for $400,000, but the appraiser comes back and says it's only worth $380,000, you have a massive problem. This is called an appraisal gap. The lender will now only give you a loan based on the $380,000 value. You, the buyer, are now responsible for coming up with that extra $20,000 in cash if you still want the house. This is where deals completely fall apart. You spend days, sometimes a week, just waiting for that appraisal report to come in, knowing it could single-handedly torpedo your entire dream. While you're sweating the appraisal, the underwriter is also waiting on the title report. A title company is busy scouring public records to make sure the seller actually has the legal right to sell you the house. They're looking for liens, which are legal claims against the property. Maybe the seller never paid a contractor who put on a new roof. That contractor could have a lien on the house. Maybe they have unpaid property taxes. That's another lien. The underwriter needs to see a clean title report, proving that when you buy this house, it will be yours and yours alone, free and clear of anyone else's old debts. If you're buying a condo or a home in a neighborhood with a homeowners association, or HOA, the underwriter will add another condition: a full review of the HOA's health. They'll request the HOA's budget, their meeting minutes, and their insurance policies. Why? Because a poorly managed HOA is a huge risk. If the HOA doesn't have enough money in reserves to fix the roof, or if they're involved in a major lawsuit, the lender sees that as a threat to their investment, your property. A financially unstable HOA can absolutely be the reason a lender denies your loan at the last minute. So you are now in a holding pattern. You've submitted all your letters of explanation. You've tracked down your parents' bank statements. And you are waiting for an appraiser you'll never meet, waiting for a title agent you'll never speak to, waiting for an HOA board to send over their paperwork. Every morning you wake up and check your email, hoping for good news. Your loan officer is your only lifeline, and you're probably calling them twice a day. Any news on the appraisal? Did the title report come back yet? During this agonizing wait, you must remember the single most important rule of the entire mortgage process. Do not change anything. Do not change jobs even if it's a promotion with a raise. Do not buy a car. Do not buy furniture on credit. Do not co-sign a loan for your cousin. Do not make any large unexplained deposits or withdrawals. You have to be a financial ghost. Your life, as the underwriter sees it, must be frozen in carbonite. Any change, any ripple could force the entire underwriting process to start all over again from scratch. You're in the final stretch. You've answered every question. You've provided every document. You've explained every transaction. You've endured the excruciating wait for third-party reports. Your file, now thicker than a phone book, goes back to the underwriter one last time for a final review. This is it. The final sign-off. The moment of truth. You refresh your email again and again. You see a new message from your loan officer. Your heart pounds. You click it open, and you read the 3 most beautiful words in the English language. You are clear to close. That feeling is pure, uncut adrenaline. A wave of relief so powerful it could knock you over. You've done it. You've conquered the mountain of paperwork, survived the underwriting gauntlet, and now you are on the home stretch. But I need you to listen to me and listen closely. This is not the time to relax. This is not the time to celebrate. Not yet. Because the moment you get that clear to close, a new clock starts ticking. A 72-hour countdown that is, without a doubt, the most critical phase of the entire home buying process. This is the final descent from the summit, where one wrong step can send you tumbling all the way back to the bottom. The first thing that happens is the arrival of a document that looks deceptively simple. It's called the closing disclosure, or the CD. Your lender is legally required to send this to you at least 3 business days before your scheduled closing date. This isn't just another form. This is the final, official, legally binding breakdown of your entire loan. It is the financial blueprint of your new life. Your job is to scrutinize this document with the intensity of a detective hunting for a single misplaced clue. You need to print it out. Get a red pen and a ruler. Compare it line by line with the last loan estimate you received. Are the numbers the same? Is your interest rate exactly what you were promised? Is the loan amount correct? Is your name spelled perfectly? Is the property address 100% accurate? A single typo here can cause a catastrophic delay. Then you get to the closing costs. Page 2. This is where the money is. You'll see a column for what the lender estimated, and a column for the final costs. Some fees, like the appraisal or credit report fee, can't change. Others, like title insurance or recording fees, have a 10% tolerance. And some, like your homeowner's insurance premium, can vary. Go through every single charge. Do you understand what it's for? Does it match what you were told? If you see a fee you don't recognize, a number that seems off by even a few dollars, you pick up the phone and you call your loan officer immediately. You don't email. You call. You ask questions until you are 100% satisfied. This 3-day window is your power. It's your legal right to review and question everything without being rushed at a closing table. It is your single greatest protection against last-minute surprises. While you're dissecting the closing disclosure, you have another crucial mission: the final walkthrough. This is usually scheduled 24 to 48 hours before closing. Do not, under any circumstances, skip this. I don't care if the house looked perfect a month ago. A month is a long time. This is not a sentimental journey to measure for curtains. This is a final inspection. You are looking for two things: that the house is in the same condition it was when you signed the contract, and that all agreed upon repairs have been completed. Turn on every light switch. Run every faucet hot and cold. Flush every toilet. Run the garbage disposal. Test the heating and the air conditioning even if it's the wrong season. Open and close every window and every door. Check the appliances that are supposed to be included. Are they the same ones? Do they work? Look for new dings in the walls from the sellers moving out. Check the basement for any signs of new water damage after a recent storm. If you had a repair addendum, say the seller agreed to fix a leaky pipe under the sink, you get down on your hands and knees and you make sure it's not dripping. If anything is wrong, if a repair isn't done, if the brand new refrigerator has been swapped for an old one, you call your real estate agent from the property. Right then and there. This is your last chance to hold the seller accountable before the deal is done. Once you sign those papers, their problems officially become your problems. Okay, the closing disclosure looks good. The walkthrough is complete. Now comes the moment you actually have to bring the money. And this is where the modern homebuyer faces a danger that didn't exist a decade ago. Wire fraud. This is terrifyingly common and financially devastating. The scam is simple. Hackers will monitor real estate transactions. They'll create a fake email that looks exactly like it's from your title company or your attorney. It will have their logo, their signature, everything. The email will say, "There has been a last-minute change to our wiring instructions. Please send your closing funds to this new account number." And just like that, people who have saved for years, people just like you, will wire their entire life savings to a criminal's offshore account, and the money vanishes forever. So here is how you protect yourself. This is non-negotiable. You will never, ever accept wiring instructions sent via email. Ever. When you get the instructions from your title company, you will find their phone number from an independent source, from their official website or from the original contract you signed, not from the email itself. You will call them and verbally confirm every single digit of the account number and routing number over the phone. You will read it to them and they will read it back to you. Be paranoid. It's okay. Ask them to confirm the exact amount you need to wire. This amount will be on your closing disclosure, listed as cash to close. It's your down payment plus your closing costs, minus any deposit you've already paid. Once you have verbally confirmed the instructions, and only then you go to your bank to send the wire. Get a receipt. Guard it with your life. The day has arrived. Closing day. You'll walk into a conference room at a title company or an attorney's office. It might feel a little anticlimactic. There are no balloons or champagne, just a very large table and a very, very large stack of paper. You'll need to bring 2 forms of government-issued ID, like your driver's license and your passport. Bring your wire transfer confirmation. And most importantly, bring your patience. You are about to sign your name more times in the next hour than you have in the last 5 years. The person walking you through this is the closing agent or settlement agent. Their job is to be a neutral third party, to ensure the documents are signed correctly and the money goes to the right places. They are not there to give you legal advice. You will feel an immense pressure to just sign, sign, sign. Don't. You have the right to read what you are signing. Now, you've already reviewed the most important document, the closing disclosure. But there are a few other superstars in that stack you need to recognize. First, the promissory note. This is the simplest and most powerful document of all. It's your IOU to the lender. It says, "I promise to pay you back this much money at this interest rate over this many years." That's it. It's the core of your debt. Next is the mortgage, or in some states, the deed of trust. This is the security instrument. This is the document that says, if I fail to keep the promise I made in the promissory note, the lender has the right to take this specific house as collateral. It's what makes your loan a mortgage. It connects the debt to the property. You'll sign tax forms, escrow disclosures, and a dozen other papers that feel redundant. And then, near the bottom of the pile, the closing agent will slide one final, heavy stock paper in front of you. This is the deed. This is not a document you sign. This is a document you receive. It's the legal instrument that officially transfers the title of the property from the seller to you. It's the proof of ownership. You'll push through the last few signatures. Your hand will be cramping. The closing agent will gather up all the copies, make a few phone calls, and you'll hear them say the magic words, "We are funded." This means your lender has wired their portion of the money to the title company. The title company now has all the funds. They pay off the seller's old mortgage, they pay the real estate agents, they pay themselves, and they pay the government recording fees. The agent will then gather a small set of keys. They might be on a plain metal ring, nothing fancy. They'll slide them across the polished wood of the conference table. They will feel heavier than you ever imagined. You take them. Your heart is hammering in your chest. You just signed a stack of paper that represents the single largest financial commitment of your life. And in exchange, you're holding the keys to your future. But that feeling, it doesn't last. The euphoria is temporary. The keys feel lighter in your pocket the next day. The reality begins to set in, not with a bang, but with a quiet, unassuming email a few weeks later. The subject line is simple. Your first mortgage payment is due. And just like that, the abstract concept of a 30-year loan becomes a concrete, recurring number on your screen. A number that will be your financial companion, your shadow, for the next 360 months. You open the email, or maybe it's a letter with a perforated tear-off slip. And the first thing you notice might be a surprise. The name at the top, the company asking for your money, it's not the friendly loan officer you worked with. It's not the bank whose name is on your pre-approval letter. Someone else. A company you've never heard of. Welcome to the world of mortgage servicing. This is the first secret of homeownership that no one really prepares you for. The institution that gives you the loan, the originator, often doesn't want the hassle of managing it for 30 years. So they sell the servicing rights, the job of collecting your payments and managing your account, to another company. Your loan terms don't change. Your interest rate is locked in. But the face of your debt, the entity you'll interact with month after month, has just changed. You didn't just marry your lender. You inherited their entire extended family of business partners. So you stare at that first bill, and you see that big number. Let's call it $2,500. But where does that money actually go? You think you're paying for your house, but it's not that simple. Your monthly mortgage payment is actually a cocktail of 4 different ingredients, famously known by the acronym PITI: principal, interest, taxes, and insurance. Let's break it down. The first ingredient is principal. This is the good stuff. This is the only part of your payment that actually pays down the amount you borrowed. It's the portion that builds your equity, your ownership stake in the property. On your first payment of $2,500, you might be shocked to learn that the amount of principal you're paying could be as low as $400 or $500. Feels like a drop in the ocean. And it is. That's because of the second, and for a long time the biggest ingredient, interest. This is the cost of borrowing the money. It's the lender's profit. In the early years of your mortgage, the vast majority of your payment, we're talking 70, 80, even 90%, is pure interest. You are front-loading the bank's profit for the entire life of the loan. Think about that. For the first several years, you are essentially just renting money from the bank. You're barely making a dent in what you actually owe. The house is yours, but the debt feels like it belongs to someone else, and you're just paying the fee to manage it. This is how amortization works. It's a schedule designed to protect the lender. They get their money first. Over time, the balance slowly, painfully shifts. Year 10, you're paying a little more principal. Year 20, it might finally be close to a 50-50 split. And in those final few years, your payment is almost all principal. But the beginning is a long, slow grind against interest. Now for the last 2 ingredients: taxes and insurance. This is where it gets even more interesting. You might think you just pay your property taxes to the county once a year, and your homeowner's insurance to the insurance company. No. In most cases, the lender doesn't trust you to do that. It sounds harsh, but it's true. Because if you fail to pay your property taxes, the county can put a lien on your house and even foreclose on it, ahead of the bank. If your house burns down and you let your insurance lapse, their massive investment, their collateral, is gone. They have too much to lose. So, they create something called an escrow account. This is the third secret of homeownership. An escrow account is like a forced savings account that your mortgage servicer manages for you. Every single month, a piece of your mortgage payment is diverted into this account. That T for taxes? That's 1/12 of your estimated annual property tax bill. That I for insurance? That's 1/12 of your annual homeowner's insurance premium. Your servicer collects this money from you every month, holds it in the escrow account, and then when the big bills for taxes and insurance are actually due, they pay them on your behalf. It's convenient for sure. You don't have to worry about saving up for a massive multi-$1,000 tax bill at the end of the year. But it also means your monthly payment is significantly higher than just the principal and interest. And here's the kicker, it can change. Every year, your servicer will do an escrow analysis. They'll look at what they collected versus what they actually had to pay out. Did your property taxes go up? Did your insurance premium increase? If so, you have an escrow shortage, and you have to make up the difference. They'll usually give you two options. Pay a lump sum right now, or more commonly, they'll just increase your monthly mortgage payment for the next year to cover the shortage and adjust for the new, higher costs. This is the moment that shocks so many new homeowners a year or two into their journey. They have a fixed-rate mortgage, so they think their payment is fixed for 30 years. But they get a letter saying their payment is going up by $100, $200, even $300 a month. It's not the principal and interest changing. It's the escrow. It's the ever-rising cost of taxes and insurance that you have little control over. Your fixed payment isn't as fixed as you thought. So you make that first payment. You set up the auto draft from your checking account. You watch that huge chunk of money disappear. And you do it again the next month. And the next. It becomes a rhythm. The new drumbeat of your financial life. You start to think differently about money. That fancy dinner out? That's a tenth of a mortgage payment. That new car? The monthly payment on that plus your mortgage starts to feel suffocating. The house is an asset. Yes, but the mortgage is a liability that reframes every other financial decision you make. But there is a way to fight back. A way to reclaim some control. Remember that amortization schedule, the one so heavily tilted in the bank's favor? You can break it. The secret is to make extra payments and specify that they go directly toward the principal. Even a small amount can have a colossal impact. Paying an extra $100 a month on a $300,000 loan could shave more than 4 years off your mortgage and save you over $30,000 in interest. It's a direct assault on the bank's profit and a direct investment in your own freedom. Every extra dollar you pay toward principal is a dollar that will never accrue interest again for the next 20-something years. It is, without a doubt, one of the most powerful financial moves a homeowner can make. You've signed the papers, you've gotten the keys, and you've made the first payment. You understand the pity, the escrow, the amortization. You feel like you've finally crested the hill. You now understand the predictable monthly cost of your home. But the mortgage is just the ticket to the game. It's the cost of admission, the predictable part. What you're about to discover is that the most significant costs of owning a home are almost always the ones you never see coming. Let's talk about that iceberg. Your monthly mortgage payment, that pity we broke down, is just the 10% you see above the water. The other 90%, the part that sinks ships, is lurking just below the surface. And it's made of two things: maintenance and surprises. A house isn't a purchase. It's a subscription. It's a living, breathing organism that is in a constant state of decay. And you've just signed up to be its primary caregiver. Every single component, from the shingles on the roof to the pipes in the walls, has a countdown timer attached to it. You just don't know what number it started on. People throw around the 1% rule as a guideline. You know, set aside 1% of your home's value every year for maintenance. So for a $400,000 house, that's $4,000 a year, or about $333 a month. That sounds manageable, right? It's also dangerously misleading. First, that rule was invented decades ago when homes and labor were significantly cheaper. Second, it's an average. Averages are smooth and predictable. Home repairs are the opposite. You won't spend exactly $333 a month. You'll spend zero for 5 months, and then on a cold Tuesday in February your furnace will die, and you'll get a bill for $6,000. The average works out, but the cash flow is a nightmare. Your water heater doesn't care about your budget. It has a life expectancy of about 10 to 12 years. One morning you will turn on the shower and be greeted with ice-cold reality. That's a $1,000 to $2,000 surprise. Your HVAC system? 15 to 20 years if you're lucky. When that goes, you're not just uncomfortable. You're looking at a $5,000 to $10,000 hole in your savings. And the roof? The single biggest protector of your entire investment? A new roof can be $15,000, $20,000, even $30,000 or more depending on the size and materials. These aren't if events. They are when events. The clock is always ticking. This is the fundamental psychological shift from renting to owning. When you were a renter and the dishwasher broke, you felt annoyance. You sent a text to your landlord. It was their problem. When you're an owner and the dishwasher breaks, you feel a cold shot of financial dread. It is your problem. There is no one else to call. You are the landlord now. But the surprises aren't just the big, catastrophic failures. It's the death by 1,000 paper cuts. It's the garage door spring that snaps on a Sunday night. $300. It's the mystery leak under the sink that requires a plumber's visit. $200. It's the fence that blows over in a windstorm, the deck that needs to be restained, the squirrels that decide your attic is the perfect place to raise a family. Every trip to the hardware store for a project you didn't plan on becomes a $50 or $100 tax on your time and your wallet. And then there's the part of your predictable pity payment that isn't so predictable, the T and the I. Taxes and insurance. These are not fixed numbers. They are variables controlled by other people. You see, when you bought your home, the county tax assessor took notice. They saw the new higher price you paid and they thought, that property is worth more than we thought. The next year you get a letter in the mail. Your property has been reassessed. Your property taxes are going up. Sometimes way up. Your insurance company is doing the same thing. Maybe there was a season of bad storms in your region, or wildfires on the other side of the state. It doesn't matter if your house was untouched. The insurance company's risk pool changed, their costs went up, and so your premium is going up too. Now, because your lender pays these bills for you out of your escrow account, you might not notice at first, until you get the second letter, the escrow shortage notice. This is one of the most dreaded pieces of mail a new homeowner can receive. It basically says, hey, we didn't collect enough money from you last year to cover your increased taxes and insurance. So now you have a shortage. You owe us that money. And by the way, we've recalculated your monthly payment for next year to make sure this doesn't happen again. So in one fell swoop, you could be hit with a bill for $1,000 to cover the shortage, and your monthly mortgage payment could jump by $100 or $200. Permanently. You did nothing wrong. You paid your mortgage on time every month. But the cost of your home just went up and you had zero control over it. This is the escrow surprise, and it blindsides millions of homeowners every single year. Finally, there's what I call the settling in tax. This is the money you spend right after you move in, when you are at your most financially vulnerable. You've just drained your savings for the down payment and closing costs. You're exhausted, and you walk into your new, bigger home and you realize it's empty. Your old couch looks tiny in the new living room. The windows have no blinds. The bedroom needs to be painted. You suddenly need a lawnmower, and a weed whacker, and a ladder that can actually reach the gutters. This isn't about luxury. This is about basic functionality and making the house livable. It's an avalanche of small and medium-sized purchases that can add up to thousands of dollars you never budgeted for, because you were so hyper-focused on just getting the keys. So what do? Do we just give up? No. We prepare. We go in with our eyes wide open. You need to build a fortress around your finances. Your standard 3 to 6 month emergency fund is for you losing your job. That is not your home repair fund. You need a separate dedicated home sinking fund. Think of it as prepaying for your future disasters. You know the roof has a 20-year life. If a new one costs $20,000, that's $1,000 a year, or about $83 a month you should be putting into a roof fund. Do the same for your HVAC, your water heater, your major appliances. By breaking down the terrifying multi-thousand-dollar future costs into small, manageable monthly savings goals, you rob them of their power to create a crisis. You turn an emergency into a simple inconvenience. And before you even buy, you must stress test your budget. For 3 to 6 months, I want you to live as if you already own the home. Take your estimated pity payment, add another 30% to it for maintenance, utilities, and surprises, and transfer that total amount into a separate savings account on the first of every month. If your estimated pity is $2,000, I want you to practice living on $2,600 less each month. How does it feel? Are you stressed? Are you scraping by? Or is it manageable? This is the single best indicator of whether you are truly ready, because owning a home isn't just about qualifying for the loan. It's about being able to afford the reality of the house long after the ink on the mortgage documents is dry. Sounds like a lot. It sounds daunting. And honestly, it can be. The financial and mental weight of being solely responsible for a massive, complex, and decaying asset is real. So after all this, the stress, the hidden costs, the weekend projects, is it even worth it? Is this American dream just a financial nightmare in disguise? The answer lies not in the dollars and cents, but in a concept far more powerful: the forced creation of wealth. And that's what we're going to break down next. When you rent an apartment, your monthly payment is a 100% expense. Think about that. Every single dollar you hand over to your landlord is gone forever. It's the cost of shelter, and in return you get a temporary place to live. Your landlord, however, takes that money and uses it to pay their mortgage, their taxes, and their insurance, and hopefully they pocket a profit. Your rent payment is building their wealth. Your financial output becomes their financial asset. Now let's look at a mortgage payment. Feels like the same thing, right? A huge chunk of money leaving your account every month for a roof over your head. But beneath the surface, something fundamentally different is happening. A mortgage payment is split into two critical parts: interest and principal. The interest is the fee you pay the bank for the privilege of borrowing hundreds of thousands of dollars. That part is an expense just like rent. It's the cost of doing business. But the principal is pure magic. The principal portion of your payment is you buying your house back from the bank, one tiny sliver at a time. It is a mandatory savings plan. It's you paying yourself. This is the entire concept of forced wealth creation. Most of us are not disciplined enough to voluntarily save hundreds or thousands of dollars every single month without fail. Life gets in the way. A car breaks down, a vacation looks tempting, a new gadget comes out. But the mortgage is non-negotiable. You have to pay it. And in doing so, you are forced to build equity. Equity is the part of the home you actually own. It's the market value of your home minus the amount you still owe the bank. Every time you make a principal payment, that amount you owe gets smaller, and your equity, your personal wealth, gets bigger. Your $1,000 rent payment vanishes into thin air. A $1,000 mortgage payment might see $600 go to interest, but the other $400 didn't disappear. It just converted from cash into home equity. It became a part of your net worth. And this process accelerates over time. In the early years of a 30-year mortgage, most of your payment goes toward interest. The bank gets its money first. But as you cross the 10, then 15-year mark, the scale tips dramatically. Suddenly, the majority of your payment is going toward principal. You're no longer just servicing debt. You're aggressively buying your asset. The wealth-building machine kicks into a higher gear, all while your payment stays the same, predictable amount it was on day one. A renter's payment, meanwhile, is almost guaranteed to increase every single year. This forced savings is only one piece of the puzzle. The second, and arguably more powerful component, is leverage. Leverage is a concept that sounds complicated, but it's actually very simple. It's using borrowed money to control a very large asset. Let's say you buy a $400,000 house. You don't actually have $400,000. You might have $20,000 for a 5% down payment. But with that $20,000, you now control the entire $400,000 asset. Now let's imagine the housing market does what it has historically done over the long term and appreciates. Let's say your home's value goes up by 5% in 1 year. That $400,000 house is now worth $420,000. That's a $20,000 gain in wealth. But what was your initial investment? It was your $20,000 down payment. You made a $20,000 profit on a $20,000 investment. That is a 100% return in a single year. You will not find that in a savings account. You are unlikely to find that in the stock market. You achieved this incredible return because you weren't just benefiting from the appreciation on your small down payment. You were benefiting from the appreciation on the bank's money, on the entire value of the home. That is the explosive power of leverage. So now we have two wealth-building engines running simultaneously. The forced savings of paying down your principal every month, and the leveraged appreciation of the entire asset's value growing over time. This is the financial engine that has lifted more Americans into the middle class than any other. But what about all those other costs? The property taxes, the insurance, the nightmare scenario of a $10,000 roof repair? Those are absolutely real. They are the operating costs of your wealth-building machine. But here's the crucial difference. When you're a renter, you are paying for those things anyway. They are baked into your rent. Your landlord isn't a charity. They've calculated their mortgage, their taxes, their insurance, and an emergency repair fund, and they've set your rent high enough to cover all of it, plus a profit for themselves. When the roof needs replacing on your rental, your rent goes up the next year to cover it. The difference is when you own the home, paying for that new roof is an investment in your asset, preserving and often increasing its value. When your rent goes up to pay for your landlord's new roof, it's just a higher expense. You get all of the costs but none of the ownership. Furthermore, a fixed-rate mortgage is a powerful hedge against inflation. Your principal and interest payment is locked for 30 years. 30 years. Your salary will hopefully go up. The cost of a gallon of milk will go up. Your friend's rent will definitely go up. But your core housing payment will remain the exact same dollar amount in year 29 as it was in year 1. This provides a level of financial stability and predictability that is almost impossible to achieve as a renter. It becomes an anchor in the stormy seas of a changing economy. We've spent this entire journey, 10 parts, deep in the weeds of credit scores, debt-to-income ratios, underwriters, and closing costs. It's a grueling, invasive, and stressful process. And it's easy to lose sight of the why. Why go through all of this? The answer is because what you are applying for is not just a loan. You are applying for access to this machine. You are fighting to switch from a position where your biggest monthly expense builds someone else's wealth to a position where it builds your own. The American dream isn't just about a white picket fence. It's about the financial security that fence represents. It's the stability of knowing your housing costs are fixed. It's the pride of owning a tangible asset that is yours. It's the quiet confidence that comes from watching your net worth grow month after month, simply by paying your bills. It's the freedom of having a powerful financial tool that can be borrowed against for a child's education or sold to fund a comfortable retirement. The mortgage application journey is a rite of passage. It is the gatekeeper to this powerful form of wealth creation. It is designed to be difficult, to ensure that those who are given the keys to a $100,000 loan are ready for the responsibility. But it is not an impossible journey. It's a journey of preparation, of discipline, of understanding the rules of the game. From the first moment you decided to check your credit score, to the day an underwriter finally stamps approved, you are on a path of transformation. You are moving from being just a consumer of housing to an owner of it. The process is a mountain of paperwork, a series of nerve-wracking checkpoints. But the view from the top is not just a house with a roof and 4 walls. It is a foundation for your financial life. A forced savings account you get to live inside. It is, for millions of Americans, the single most powerful and accessible wealth-building tool they will ever have. And now, after this journey, you understand exactly how to make it yours.